you. Happy New Year. Welcome back.
Thank you, Scott.
So where are we in this market? Well, it feels like it's a little treacherous, tumultuous, and then all of a sudden we've had a nice rally and maybe we're feeling better and yields are cooperating.
Yeah, well, but, I think we have to look at that CPI report this morning. Now, it wasn't as bad as some had thought, but it wasn't good. And as one of our participants here said, I'm looking at oil at 83. I mean, that's like $1 from its high. Energy was minus 4% in that December figure. It's not going to be minus 4.4% in the January figure. Everything is pointing upward. I mean, some of the people saying, oh, well, the services is we look at hospital services. Do we know what's happening in the hospitals? Do you think that those services are going to stay only 1% above the cost of what it was a year ago? Everything is going up. And as I've said, Scott, and you interviewed me all through last year, the Fed is going to have to be far more aggressive than certainly what they thought last year. And in my opinion, far more aggressive than what the street thinks this year.
But Professor, okay, I'll give you the benefit of the doubt and say, okay, you're right. Everything is going up. Theoretically, it is everything that's going up. But it's not going to stay up forever, Professor. This is all pushed on by mostly, I know some are going to be throwing their stuff at the TV saying, well, it's the Fed, the pandemic. I mean, we got supply shortages as a result of the pandemic in a lot of stuff, commodities and semis and autos and this and that. I could go on. And that's the principal reason that you've got the inflation that you do. And then come later in the spring and in the summer, it's going to moderate. Why is that not going to happen?
I don't think that's true. I think it's too much money. I mean, when you have a 35% increase since March of 2020, something that we have never seen before. When 2020 money growth exceeds anything in our 150-year history that we have money growth. And this year is 2021 was 15% money growth. This is way too much money. This is a demand problem, not just a supply chain problem. This is too much money chasing too few goods. Prices are not going to go down. The question is, when are they going to stop going up? And
you might
I think
be right.
That will happen.
You might be right. Look, you might be right on wages. Those may not come down, but other things have already come down along the commodity complex.
The general commodity indices, take a look at the CRB index, take a look at the Goldman Sachs index. They are right near their all-time highs. Yes, certainly lumber had soared last year, and it has come down from its highs and a few of others. But if you take an average of them, they are near their own time highs. And as I said, you take the most important one of all, oil, that it's back up at its all-time high, despite the Omicron virus and the travel dearth of the cancellation of flights and planes, which is definitely a big user of oil. All that oil is near its all-time high. That does not bode well for 2022, in my opinion.
You sound like you're running around saying the sky's falling, the sky's falling. Are you selling everything you have? I mean,
No. Listen, as I said, stocks are real assets. You just can't hold paper assets, which are bonds. They're the worst. Stocks are real assets. What higher real rates does mean is the rotation that we've been talking about. That certainly happened in the first week of this year, and I think it's going to happen throughout the rest of this year. No, I'm not out of stocks, but because people are going, Tina, right? There is no alternative. Where are you going to go? You're going to go to bonds. You're going to go to cash, which is disappearing. It's 7% inflation, which is going to go higher, in my opinion. It's disappearing at 7% a year because you're getting no interest on it.
Okay, so you want to stay. So you want to stay in stocks, but it also sounds to me like you're suggesting that this is finally values moment, or cyclical stocks are going to dramatically outperform growth and technology because of where rates and the Fed are going to have to do their thing. Is that right?
Well, certainly I think so. I think, listen, dividend stocks are protected against inflation because firms have been able to raise their prices, their cash flows, and increase their dividends. And I think that is what investors are going to seek in 2022. Dividend, you could go to tips at -1. That's not an answer. You have dividend paying stocks at 2.5, 3, 3.5, 4, well-protected dividends that are rising, and you have capital gains.
Professor, you are talking Jenny Harrington's language. I need to get her into the conversation right now. I need to see her on camera, make sure she is still sitting in her chair and not standing up, jumping and cheering at what you're saying.
I am, and my heart's growing 3 sizes. And thank you so much, Professor Siegel, for the endorsement on the dividend stocks.
Thank you.
One of the interesting charts that, no, thank you. One of the interesting charts that Joe showed before was the correlation of the NASDAQ and the 10-year Treasury. And as you know, there's an even more interesting correlation between CPI and the 10-year Treasury. So I would love for you to talk a little bit about where you think the 10-year goes as it correlates so closely historically with CPI.
Well, certainly, if we go back in the 70s, we had very, very high interest rates and high inflation. A lot of people are puzzled. Why isn't the 10-year higher than it is now? And I've written about this. The 10-year has become the favorite short-term hedge of so many money managers, because we know if the Dow, something bad happens, the Dow's down 2,000 or 3,000 points, your treasuries are up 3 points. And that cushion, that insurance policy, has become, and the statistics show that, more valuable over time. It's not an answer for long-term investors, but short-term investors who like a little short-term cushion are willing to pay the price. I think they're paying far too high a price for that. But that's one reason why the 10-year is not 2.5 or 3% now, is that there's been a tremendous flood of demand into longer-term treasuries as that so-called risk asset hedge.
Hey, Professor, can you do me a favor? I don't know if you have a class to go teach or if you have an appointment. Can you stick around? Can we take a break and come back and continue our conversation? I got to pay some bills, but I don't want to lose you. Can you hang with me?
Unfortunately, today I do have something at 12:30.
Oh, Professor.
So another day, Scott.
All right. Let me ask you one last question, though. One last question. There are forecasts that we can hit, I don't know, 5,100 this year, 5,200 on the S&P. Does that make sense to you?
Yes. I mean, it does, because again, people are going to say, I've got to be in real assets. Interest rates are going to go up, but that makes bonds worse, by the way. I mean, until you wait for the interest rates to go up. And still, what's a 2 or a 2.5 and a 3% bond when you're having 5, 6, 7% inflation? That's not a good answer either.
All right.
Stocks are a place to be.
All right. You go to your appointment. I apologize for negotiating with you on live television, but I wanted to see how far I could go. So we'll talk to you again soon.
Absolutely. Thank you, Scott.
Yeah, you take care. That's Professor Jeremy Siegel at the Wharton School. Financials hitting record highs again. Big banks reporting earnings in less than 48 hours from now. We have a number of bullish calls on one stock ahead of that. We'll talk about it next.